Nitin Raheja, what is your sense? Do you think worst of the print for this calendar year is behind us? Whatever could go wrong has gone wrong, and we've emerged on the right side of the trade?
No, I wouldn't say that, Nikunj. I think, it's yet early days into the rally. Of course, we know markets always work contrary to most people's expectations. And, as we were coming close to end of March, we were in such a negative mode and, the markets had gone, a couple of times and around the 16,000 and just below. So in that sense, it's been a good rally that we've seen in the markets. And generally the earnings seasons normally start off in a positive mode. You normally get to see, most companies who are, except you take some of the IT packs, which generally deliver earnings irrespective of their business. But most companies, when they have good numbers, you will see them come up early with earnings. So I think you are going to see some of that happen. So I think in that sense, the fact that the RBI held rates, has also sort of played into this whole positive sentiment. But I think it's early days to call. I think we are yet trading in a range. You are going to see a reallocation of money in the short term towards fixed income and debt happening. So I think I would not like to call it that that the worst is over. You might probably get that volatility once again, but very difficult to call. But I would believe that we are yet going to trade in this range for some time.
Naresh, wanted your take regarding a couple of these large caps which are sitting at all-time high levels or very close to that. ITC is almost at that 400 rupee mark, so a 2.5% gain today, and sitting at an all-time high level, and even L&T just around the 2300 mark, close to the all-time high levels as well. Your take as to where they are headed? Time now to profit book or continue building on?
So ITC is something which is getting closer to a point where the risk rewards are not that great. So if you look at the current breakout, it's a range breakout of say 370 to 392 zone. So roughly a 20-25 point range. That would give us a target price of 410 to 415, and then again a pause. So out here, the case is one should be using a trailing stop loss methodology rather than booking right away. But a fresh trade has a very small trade out here, wherein the target would be 410. So it's no more the best place to be. But L&T is the one which is starting off a longer term uptrend. When I say longer term uptrend, the stock made a top around 2015 to 2022 start. That was a breakout 3-4 months back. After that, we consolidated between 2050 to 2250, and a fresh breakout has taken place into a new all-time high. So out here at current levels of 2300 to 2250 is a buy zone. I would have a target price of 2500 to 2600 in the short term, could be higher also in the medium term. So with a medium term perspective as well as short term, L&T looks a good investment bet as well as a trading bet, and the whole capital goods sector has done well. L&T has a lot to catch up.
Okay, that's L&T in trade. Managed to hit a 52-week high just yesterday, and Kotak Bank is the one which is winning all the way today. In fact, let's take it across to Samit and find out why exactly is Kotak buzzing in trade today.
Well, if you see the March 2023 shareholding pattern that has been declared by Kotak Mahindra Bank, what we're understanding is that the foreign holding in the bank, that is the FI holding in the bank, has declined by around 1.47 percentage points to close to 41.22%. Now, this could result into headroom for the FI holding increasing to around 25.05% versus the earlier limit of around 22.38%. Now, as per the MSCI rule, if the foreign headroom is less than 25% but equal to a higher than 15%, then the price adjustment factor stands at around 0.5 times. But given that, and this was the case for Kotak Mahindra Bank so far, but given that the FI headroom for Kotak Mahindra Bank has now just increased above the 25% mark, the price adjustment factor for Kotak Mahindra Bank would now be around 1 time. Now, as per MSCI, as per the shareholding that has been released, there is a high probability that the price adjustment factor could be adjusted for Kotak Mahindra Bank in the May 2023 review, and there's a high probability that the weightage of Kotak Mahindra Bank in the MSCI index could increase. Now, as per Nuvama, the potential increase in weightage could lead to an inflow of close to 690 million US dollars, and the stock has been languishing in trade, and this could be an upside trigger. That is, the MSCI inflow could be an upside trigger for Kotak Mahindra Bank. Now, apart from Kotak Mahindra Bank, there are also a host of other stocks that would remain in focus because of the MSCI May 2023 review. Firstly, there's a possibility that ACC might be removed if the stock continues to trade below the 1,730 rupees mark. Hindustan Aeronautics has a high probability of inclusion, whereas Indus Towers has a high probability of exclusion from the MSCI index. And lastly, if you see, Power Finance also remains in focus, because if that stock continues to trade above the 160 rupees mark, then there is a high probability of the stock getting included in the MSCI index.
Bajaj Auto above the 200 DMA. You've got Axis Bank, which is above the 200 DMA. We'll play an excerpt of our interaction with Axis Bank, where interestingly, Amitabh Chaudhary is not talking about growth expansion, he's talking about growth moderation. When I say growth moderation, the credit growth moderation. I mean, other things equal, Axis Bank is in a very formidable space because they've got the insurance business and they have now the city credit card business. So the two ends which were missing links for Axis Bank, let's say a couple of years ago, when it was a universal bank and it only had a securities business and a fee-based income model. Now they've got insurance, and now they also have the city credit card business. Let's hear out Amitabh Chaudhary, and then we'll understand the future of Axis Bank with our experts. Mr. Chaudhary, investor perspective, how does one choose the best private bank? Because each private bank has a unique USP. Each private bank has a unique, brand recall. But all of them, in a sense, in last 5 years have given equal or similar returns. Whether we look at Kotak or whether we look at HDFC, Axis and ICICI Bank. 5 साल में return almost same hai.
Yeah. So I think, Nikunj, for us, one of the very clear parameters is that we don't look at these banks as lending institutions. For us, it's really a risk management culture. And out there, if you really look at it, I think any bank which has been able to register growth and build, so really 3 parameters: A, maintain growth consistently; B, have a liability franchise which is significantly better than the others in the market; and 3, keep your books clean. So really, if you look at it, these private banks have all been at different stages of journey. In that you have the leader who has almost been very consistent, but had issues with technology and then sorted that out. Then you had the other one who came back with a long hiatus of cleaning up the books and virtually not growing the balance sheet, getting into an aggressive mode, having cleaned up its act. And so I think, really speaking, for us, it's been, sticking with the top 3 private banks of size as such, and who have been able to grow, with that attendant size. And, so Nikunj, really in 2018-19, we took a call that we see a consolidation happening in the sector post the IL&FS scam. We saw the big becoming bigger because they were raising liabilities at almost often 150 to 200 basis point discount to their peers, that's the tier 2. And that's why you see these top 2, 3 at close to 52-week high, while the tier 2, tier 3 are nowhere close to the valuations that they used to enjoy even pre-2018. So, that's how we've sort of looked at these banks.
Well, the banking names are actually doing quite well today, starting with Kotak Mahindra Bank itself. IT is not. The top 4 laggards from the index are actually from the IT sector, leading with TCS, which is down 1.5%, and Infosys, HCL Tech, Wipro, they're down anywhere between 1 to 2%. We'll do one thing, we'll slip into a very short break. When we come back, we'll put the spotlight on TCS as to what the expectations are from Q4 tomorrow.
Back with closing trades right here on ET Now. Let's just revisit what the closing trades are looking like. 17,783 for the futures, 101 point higher. Kotak, Naveen Fluorine, Bajaj Auto, Concor, even a JSW Steel. These are all your big winners in today's trading session. The breadth of the market is not as robust as what the benchmarks are doing. But it is marginally in favor of the advances regardless. There are pressure points like TCS, for instance, that's at the day's lows. It's down 1.6%. Infy is down 1.5%. HCL Technologies, Wipro, TechM, the entire pack is a drag ahead of the numbers coming in from Infy and TCS. There's Berger Paints, MCX, ABB after that Kotak downgrade like we earlier highlighted, UBL and Delta Corp, which are also laggards in the session. In fact, Anisha, you've been working on the IT earnings. What's the expectation from a seasonally muted quarter?
Well, the expectations are muted itself, though having said that, at least TCS is likely to outperform. That's the word coming in. So today the stock might be down about 1.5%, but if you look at the 5-day move, the stock is still trading with a bit of a gain, and that's because, as I pointed out, TCS is likely to outperform. We are working with a revenue growth of around 2% in dollar terms and rupee terms, and the margin is expected to expand by 50 basis points. That is because the utilization of the freshers is going to be better, plus the currency tailwinds are at 10-quarter high, and that will aid the margins as well. Deal wins were also quite steady actually for TCS this time around. So the street is working that the number is going to be at least $8 billion. They have been guiding that on a quarterly basis it will be between $7 to $9 billion. We are expecting that it's going to be towards the higher end of that range as well. Profitability as a result of all of this is expected to jump by 6% sequentially. 11,500 crore thereabouts is what the street is penciling in, with a constant currency growth of around 1%. The key thing to watch out for, of course, will be the management commentary, because this is the first time they'll speak a bit more about FY24 guidance, whether the double-digit growth will continue or not, because the street is already penciling in a growth profile of around 6 to 8% for TCS next year. So is there any improvement in that or not? As well as a word on the margins, when do they want to come back to that 26 to 28% aspirational band as well? Buyback is a possibility as per ICICI Securities, so 20,000 crore is what they are penciling in with respect to the buyback news. But with the transition happening at the top level, the BFSI vertical seeing the challenges across the board, plus headcount, which has been declining at least in the last quarter, these things will remain important as well. But Kunal, I wanted to get a sense from you as far as the IT pack is concerned. Is there a trade at all ahead of earnings, specifically on TCS and Infosys?
So I think at 3,200 levels where TCS tested today on intraday session, I think just about an hour or so back, I think that could be a good zone to go for a contra buy on the stock now. Indicators are coming back into an oversold territory for the stock price. So you may play for a trading pop over here. I think the best way to try and trade TCS would be to look out for this in terms of options. So maybe 3,200 call options for someone who's looking out for at the money strike, and for someone who's looking out for a slight out of the money strike, I think 3,300 call option for the April series would be a good strategy.
Now let's look at this 5-year relative comparison data. You always look at investing on a relative and on an absolute basis, but when you're looking at matured companies, when you're looking at Nifty, when you're looking at big banks, you always look at historical growth numbers and historical averages and compare them future growth numbers. So the P multiple for IT, large cap IT, TCS, Infosys, Wipro, all of them are either at a 5-year low average or they are nearing there. That data point will just come up on your screen. Nitin, now it's easy for me to say that IT stocks have underperformed. They are nearing their averages if I look at the 5-year average, and it is a buy. But do you think that is one part of the story? The other part of the story is growth, which is getting challenged?
So I think, if you really ask me, a lot of that is already in the price, Nikunj. I mean, everybody is talking about growth and everybody is talking about how, there is going to be slowing growth, a recessionary phase in the US, and so on and so forth. And that has seen a very, very strong correction in each of these companies, if you see over the last 1 year. So I think a lot of it is already built into the price. My own view is that if you really look at these businesses, they've been through these cycles and they've been through worse cycles over the last 25, 30 years, and have shown through these cycles their ability to generate cash, their ability to pay out dividends, their ability to buy back stock. So I personally think that 6 months down the road, we might be looking at things very differently. And these are good, if you would ask me, value or contra plays in the cycle. IT is here to stay. It's not going anywhere. And, if you're talking of growth having slowed down from the 12-14% to the high single digits, you've already seen a 25 to 30% correction in prices across the board. So, I would think that there is value sitting out here in the sector.
Your take on a couple of these auto names which are actually bouncing back. Bajaj Auto, of course, the announcement came yesterday during market hours regarding their tie-up with Triumph. But the street seemed to be penciling quite a bit on account of that. And Eicher Motors too is quite excited today, 3% higher. Naresh?
So Bajaj Auto has finally given that breakout. So if you were to adjust it for dividends, also the stock has actually come to a new all-time high. If you were to adjust it for dividends, technically in the short term, 3,900 to 4,000 was a major problem for the last 1 year, and it has clearly taken it out today. We are well above 4150 levels right now, indicating a fresh start of trend out here. So any dips back to 4,000 to 4,100 zone would still be a place to add. A buy at current levels also would have a target price of 4,500 on the stocks. So looks very interesting. Eicher Motors, on the other hand, has corrected from 3,900 to almost 2,900 levels. So it's a bounce back candidate wherein 3,250 to 3,300 would be a tough ask. So Bajaj Auto looks interesting. The stock has actually given a breakout, taking leadership, very similar to what happened with TVS Motors a couple of years back when it took leadership, and it continued to do well over the next 1 year. So I would be extremely bullish on Bajaj Auto.
Okay, Nitin, what's your take regarding the hospitality sector? Because we were just discussing with a couple of managements as well at Lemon Tree, Chalet Hotel, and they are saying that the higher rates are likely to continue because A, the demand is so strong, and secondly, for them as well, the costs have gone up. But from a demand point of view, would you still say that these are good businesses to invest in? Because profitability wise, they have more often than not disappointed.
So look, they're coming back after a very, very long cycle. It's a cycle in which hardly any capacity got created in the industry. And so when you have really seen demand come back, and anecdotally, when we travel around and, at least when we talk, we see A, business travel having gone up tremendously. B, you're seeing, there is this newfound flavor of people wanting to discover India back, and that is sort of manifest, in sort of anecdotal conversations that we have with people. So I think, hotels will probably continue to have a resilience as far as their ARRs are concerned. But, the real question is, from our perspective is, are we seeing peak margins out there? And I would tend to believe that the margins that we are seeing for some of them will be peak, because a lot of them would now start looking at, getting into a capex or expansion mode, even though it might not be the heavy capex that we have seen in the previous cycle. But, from an earnings perspective, this could be peak margins, and that's my sort of fear for the sector from a valuation perspective.
Okay, Nitin, we let you go on that note. Thanks as always for taking the
Thank
time
you.
out and joining